Over 50% of all households in Europe have an insufficient understanding of what investing actually is. I wish I knew all of this stuff like a good decade ago. I'm offering you basically a shortcut to some of the key foundations, the key concepts in investing. This video will be a little longer, but hang in there. The time that you invest in understanding these concepts right now will pay you massive dividends down the line. And to make sure that this video gives you as much value as possible, use an accompanying document in the description of this video. It's for free, so just hit the pause button now, download that document from in the link in the description. I'll wait here until you're ready. All set? This is what we're going to cover. Investing, what's in a name, why invest, the time horizon, components of return on investments, the risk-reward U kind of triangle, types of investments, your financial environment, investment systems, and I'll also just wrap things up a little bit in the also section, where I also give you a few more tips on how to proceed after this video. And you will want to also watch until the end of this video, because we'll learn something from dead people. Let's start with the basics. What is investing really at its core? So you put some resources out there to work for you, and you hope to get more resources in return. And this idea applies to all kinds of resources that you can allocate. So your time, your energy, also if you have a garden, the seeds that you plant and you hope to harvest some fruits down the line. And so in our context, of course, we will be focusing on money, because that's the thing that will allow us to buy the other resources like time. But just keep in mind that there is more ways to invest than just money. Okay, this brings us to the next section. Why invest to begin with? Because you want something. So let's think about what goes into it psychologically when you decide to invest. You make the hard decision to sacrifice your access to your capital, or to a part of your capital, in the hopes of getting a bigger capital down the line. This is hard, and this takes discipline. For this to work well, you also have to know what you're doing. In my case, I would like to have additional income so that I can choose more freely what I do with my time, whether I work or whether I do something else, and that's my driver. And you'll want to find your drive. Do you want to retire early? Are you saving up for a trip around the world? Do you want to purchase a large real estate? Pause the video at this point and fill in that info for yourself in the separate document. The time horizon. The more time you have for allowing your investments to grow, the more risk you can actually take early on. Because if you do, you also get a chance at getting that sweet higher return, right? This is one of the cool things about investing. When it works out, you can get a really high return on things. And if it does not work out, no problem, because your timeline is so long that you still have enough time to recoup whatever loss you made. The opposite is also true, right? If your timeline is shorter, you will want to take less risk, because if things do not work out, you don't have all that much time to recoup your loss. So for me, I'm looking at a time window of like 10 to 15 years down the line to get my additional income streams to the point where I would be able to make that choice, right? Do I want to still be employed? And maybe the answer will be yes, but I'll have that choice. That's going to be important. How much time do you allow yourself to collect the reward of your investments? So pause the video and just answer that question in the sheet. Next, types of return on investment. When it comes to investments with money, investors really are looking at three main ways to get a return. You have through dividends. So that's, for example, when you own company shares and some of their profits will be then paid out to you. Then through interests, and this is where you act as a lender of money and people pay you back the principal plus an interest on top through price appreciation. So you buy an asset and after a while that asset becomes more valuable than what it was when you actually bought it. And so then you can sell it at a profit. And very often you'll have a mixture of these, right? So you can have company shares that give you both a dividend and can appreciate in price. Personally, at this point in my life, I don't really need any cash returns via dividends or interests. So I tend to invest in financial instruments that directly reinvest whatever proceeds that I get or assets that appreciate over time. So maybe you already have an idea of what kind of assets you're interested in and what kind of return you would like to have. So just go to the file and fill that in over there for yourself as well. Types of investments. There are too many financial instruments to list them all here exhaustively. And so we'll limit ourselves to the basic ones. Company shares or stocks, that's by far probably the best known financial asset out there, right? You own a publicly traded company, or at least a share of that company, and this ownership can be interesting because it sometimes comes with additional rights. So it can also give you a dividend, or it gives you voting rights whenever big decisions are coming up. Just make sure to read up on what exactly comes with the share of a company if you're interested in buying one of those. Shares were my first type of investment, and I didn't know what I was doing back then, and so I took quite a few hits, and that's really normal because shares are often considered more high risk, but also high reward if things work out well. Then next, bonds. Bonds can be issued by companies or by governments, and it's basically loans that are financed on the public market, on the public exchange. If you hold a bond, you can expect to get that principal paid back after so many years when it matures, plus a set interest rate. These terms are communicated in advance, it's very transparent, and so these are often considered to be less risky. The interest rate will be lower on these. Real estate is another popular investment asset. I'm gonna cover two flavors of real estate investment over here. First, you can own one or more houses just by yourself. You can do that, and the advantage is that there is always a need for housing, no matter whether the economy is up or down. A constraint that you need to keep in mind is that you'll have to maintain the properties or delegate that to a company or someone who does that for you, but so that will bite into your profits. And additionally, it's pretty capital intensive to get started and not easy to sell off if you need the money urgently. Real estate investment trusts, or REITs, are a lower cost alternative where you can still invest in real estate and collect some of the rent, but these REITs are essentially companies that manage buildings, infrastructure, or other types of real estate. They then distribute the majority of the collected rent in the form of dividends to their shareholders. It's pretty liquid too, right? So you can just buy a REIT on the exchange markets like you would any other share. Next, funds and exchange trade funds, or so-called ETFs. These are collections of bonds, shares, and even REITs. Can be mixtures. A key difference is that funds are typically run by humans and exchange traded funds are run by a computer. And this has also a big implication in the costs that are associated with running these. So most of the time, exchange traded funds are going to be cheaper to buy and to maintain, where you only pay a very small percentage as an administrative fee. To me, it's still unclear which added value funds offer over ETFs, but if you have any ideas on that, feel free to hit the comments below and tell me. Other than the types of investments that I discussed right here, you have plenty of other things you can look at. Less mainstream options are peer-to-peer lending, ownership of non-publicly traded companies, or collecting art. Some people have collections of watches, which they hope appreciate over time. And I also would be remiss, of course, not to mention cryptocurrencies, but very transparently, I am not investing in any of those. So, of all of these financial instruments, what speaks to you the most? Feel free to jot down your answer in the sheet. And if you wish to share, I am pretty eager also to see what you're going to invest in. Just share in the comments down below. The risk-reward U triangle. I learned my lesson the hard way. So this is always my first task now before investing. Do I understand the rules governing the investment in both the good and the bad scenarios. And more so than the reward aspect, understanding the risk aspect is one of the key skills that you need to develop. If things go bad with your investment, how much are you losing? And how likely are things to go bad? But on the opposite, you also want to know, and what happens if things go well, and how likely is it that things will go well? So you need to really get that understanding. And then, are you okay with these conditions where things could go bad or well? And the balance that you find with these questions is called your risk appetite. And a general rule of thumb is that if you take more risk, you should be getting a higher reward. The opposite is true as well. If you never take a risk, the reward that you get might be pretty low. Next, your financial environment. The country in which you live has a major impact on what kind of investments are available to you. Not all investment types are available across borders. Take, for example, US citizens who want to invest in Europe. A lot of European companies will not want to register any US citizens because the know your customer requirements are too stringent. And so your country may have regulations in place that limits how soon or how much of your investments that you can sell off. And these rules may differ for each type of investment. Part of these regulations are related to taxes and tax exemptions. For example, many countries will favor pension schemes by not levying taxes for a long time. In other countries, employers are incentivized to offer certain contributions to corporate pension funds or other constructs. So really do your homework, have a look at that for your own country, see what is advantages. If you'd like to have some advice on that from someone, ask a banker or an accountant to shed some light on that, or these days, ask a bot. Next, investment systems. According to the statistics, all of the best investors in the world have two characteristics in common. One, they're very diversified, so they've got a very diverse portfolio. And two, they're dead. Yes, you heard that correctly, they're dead. It blew my mind when I heard about this. And before we talk about the dead aspect, let's have a look at the first part, the diverse portfolio. Would you rather own one business completely, or would you like to own small pieces of a million businesses? Owning this one business is the worst option if you just look at your risk, because statistically, you're much better off owning these small pieces of a great number of companies, because all of the risk that you take there is spread all over these companies. If you only have one company, all of your risk is concentrated in this one company. And so if it goes down, your capital goes as well. And now what you've been waiting for, what can we learn from the dead? Don't try to actively manage your portfolio. Don't try to time the market, because the dead are really, really good at just keeping their shares and bonds and whatnot through all of the ups and downs of the market. So what can you learn from this as someone who's still alive and hopefully alive for a long time to come? Automate as much as possible, and don't look at your investments, as hard as that can be. Get an automated transaction from your banking account to your trading application with an automated order, and you should reap the same benefits as the dead. Everything we touched upon so far is just the foundational layer. There's going to be more videos down the line where we look at more detailed things, and yet I feel pretty confident already that with the information that you've got in this video, you already feel more confident when you start looking at what you would like to do and what you'd like to achieve and how. So this video focused a lot on knowledge, and that's great, you need that. But what you also need is skills. And one of those skills is, for example, how to calculate a healthy reward risk ratio for yourself. And I explain all of this in this video over here. So go check that out. All right, thank you so much, and catch you next time. Cheers.